Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today's Tuesday. It's December 20th. The week has got only a couple of days left because it is a fragmented week because we've got Christmas, which means a lot of market participants are out of town traveling and not trading this market right now, which makes it even more difficult because you've got a lot of retail traders without a lot of volume, just moving the market back and forth and triggering stops unknowingly, which algos are very happy to take advantage of and revert course the other way. It's about 8:08 in the morning. The market's going to open up in an hour and 22 minutes. And as you can see here, even after having 4 or 5 down sessions in a row, the NASDAQ is down pretty good. Also, just want to point out the bond market is down 1.30, which is substantial, which puts more pressure on stocks, especially tech stocks. And I hate to say I told you so, but we shorted the bond market right around here, and we're now getting it on the downside. But it was very overdone to the upside right here, as you could see. I was a few days early, just a few days early. I think it rallied from 106 to 109. But now we're getting our groove back. And we should be in the money today, maybe tomorrow. But I'm expecting more downside. And when you look intraday at the bond market, you'll see there's not much holding it here. And if it breaks this level right here, the next major level is 101.90, 93, 92. So you got to be very, very cautious with the bond market if you're trading it to the upside. Also, remember, when bonds go down, interest rate yields go higher. Interest rate yields higher are really bad for the stock market. So this trading action that we're seeing right now in the bond market, taking bonds all the way from 110 to 103, they're not doing the Fed any favors, and they're not doing the stock market any favors. Now, before we get into the nitty-gritty, we've got housing starts and permits today. The expectation is 1.4 million units. As you can see here, residential construction has been slowing down significantly. So it'll be interesting if this number is down. If the number is higher than expected, then it can give us a little bit of juice that we need. But you could see that this week we've got a lot of stuff on the table. You've got consumer confidence tomorrow. You've got existing home sales tomorrow, and then you've got the GDP report. And I'll talk about this as we get closer to it. Now, let's talk about pre-market briefing because there's a lot to talk about. And also, before we get into the pre-market briefing, just want you guys to know that there are some earnings on the table today, significant earnings. You got Nike. It's a pretty big consumer stock right there. Can't wait to hear what they have to say. You've got General Mills. That's one of my favorite and one of my first recommended consumer staple stocks. I recommended the stocks to you guys back when I was in Winnipesaukee 2 summers ago. And people were like, why are you looking at this stock? Well, people now know why. FedEx, which is a transport company. So you got consumer discretionary, you got consumer staples, you got transports, and FactSet Research, which is a financial company. So you've got a little bit of everything today, so we've got to watch the market really, really closely. I don't know if they're coming out before or after the opening bell or after the closing bell, but either way, FDS, FedEx, General Mills, and Nike are all on the table today. So 3 major U.S. benchmark indices closed lower for a 4th straight session. NASDAQ dropped the most as market participants' risk appetite waned amid renewed fears that the Federal Reserve's hawkish stance could push the U.S. economy into a recession. And as I keep telling you guys, we're already in a recession, a mild recession. In Monday's trading, Meta, Facebook led the drop in big tech, tumbling 4% after European Union charged the company with antitrust violations for limiting competition in the market for online classified ads. I think that's really interesting. The tech conglomerate faces a fine of up to $11.8 billion. That's with a B if found guilty. Also, consumer discretionary was amongst the biggest sector laggard, weighted down by casino, travel stocks, fresh wave of COVID infections in China. That's why we're short Marriott and Six Flags Magic Mountain and Garmin and all those other stocks. Now I hope you guys are finally starting to connect dots. Now here's something interesting. Remember yesterday, this was at about 75%, and this was at 25%. And as the market goes down, the odds of seeing interest rates go up 50-point increases, as I told you it would. So don't be surprised if these numbers continue shifting if the market heads lower, and the 0.35 may end up being 0.45, 0.50, or even 0.55 if the market makes new lows. But keep an eye on this number because it's fluctuating. This number is already 5 to 10% higher than it was yesterday. Don't quote me on the exact number, but it's definitely higher. All eyes are on building permits. They're looking at 1.8485 compared to previous value of 1,512,000. That's quite a bit. They're looking at housing starts, which is what I'm really looking at, and I'm looking at 1.4 million. That's the big number. The Eurex futures were higher this morning as investors assessed interest rate outlook for 2023 as Bank of Japan unexpectedly changed its ultra-low dovish stance and struck a less accommodative tone in the market. That's actually, in the short term, it's not a great thing, but in the long term, they're finally wising up. China, oh boy. Shanghai Composite closed lower after People's Bank of China led its benchmark lending rate at historic lows. The move shows the Chinese government is maintaining a policy to accommodate consumers. Chinese equities were sold off on uncertainty, COVID cases right there. It's really that simple. And Japan plunged over 2%. That's quite a bit for the index to a 2-month low after the Bank of Japan widened the range of yield fluctuations in the benchmark government bond as the country grapples with soaring inflation. But, I'm going to tell you that may not be the worst thing because they've been keeping things real low for quite some time, and that's not always the best way to go. As I mentioned, we've got housing starts today. That's the big report. Tomorrow, consumer confidence and existing home sales. If you look at the indices, and we definitely want to look at the indices, you will see that the Dow Jones, which is down 159 points yesterday, is bouncing off the 200-day moving average. Now, I don't think the Dow has any business being above the 200-day moving average, and I think it's going to break down, and the next area of support is at 31,700. Now, here's something you do need to know. Oh, it just rallied hard, and now it went negative again. Might have had some news that just came out, but here we are. We're near the 200-day moving average, and I think I'm not seeing any major bounce off these levels because the market's not bearish. Maybe up a little bit and then down again, but I think we're going to just kind of hover around the 200-day moving average. Now, again, if we break the 200-day moving average, we're going down about 1,000 points on the Dow, which is not nothing to write home about. And as I mentioned, the bond market's already down 1.36. It was down 1.68 yesterday for the whole day. So it looks like the bond market is finally starting to come to common sense and realize that interest rates are going to stay elevated for quite some time. And the Fed is not going to rescue this market as market participants believed in this route up right here that went from November all the way to December. That November was a strong bull market run. Now, looking at market performance, why am I so skeptical that the Dow is going to go up? I'll tell you why. Because right now the S&P has 49% of stocks trading above the 50-day moving average. We don't even have 50% of stocks in the S&P trading above the 50-day moving average. And I hate to say I told you so, but I did. Well, actually, I don't hate to say I told you so. By you listening to when I say I told you so, it keeps you out of trouble. Notice there's a lot less green here. Notice there's a lot less green everywhere here. Notice how it's moving this way. Well, guess what? This is getting pinkish too, or reddish too. So purple. Materials, one more day, 2 more days, and we're done. The bottom line is, folks, I like how utilities are holding up though. And I like how energies are holding up here. But the bottom line is there is no stability in this market. NASDAQ 100, 49% of stocks are trading above the 50-day moving average. 200-day, 41%. Not a lot. Nothing good is happening here. And if you look at momentum levels, which I've been talking about, which were up, this was at 95th percentile 2 weeks ago, right here. Look, 95th percentile. Look at how we're going down, just like we went down here. And if you want to get a little more specific about it, which I know you do, look at that, just coming down, and it usually doesn't stop right here. It continues going down all the way. Look at it in 3 years. Usually comes down anytime it comes up here. Even when it doesn't, it goes down quite a bit more. Look at that, all the way down. Look at that, all the way down. Now here it spikes, and then it comes right back down. And look at it on a max level. When it comes up here, they come down. There's not much to say about it. Now, looking at sectors, we've got healthcare, consumer staples, industrial, financial, energies, utilities. Can you imagine that? The defensive stocks are leading. So I'm still bullish on healthcare. and I'm bearish on consumer discretionary and communication services and technology. And quite honestly, right now, I'm not really differentiating too much between them. They're all doing the same thing. And if you don't believe me, take a look at the charts. Look at communication services, almost at the low. Look at consumer discretionary, already past the low. And look at technology, heading towards the low. So there's very, very little difference between what's happening right now with these assets. And I would be very cautious. So if I was a betting man or a trading man, I would want to pick the best healthcare stock and the crappiest and the crappiest discretionary stock or tech stock. So I would go back to Cardinal Health. Yes, Cardinal Health or Lamb Weston, LW or CAH. I've only been talking about these stocks for the last 3 months, or Cigna, or Lilly. All these stocks are great. I just gave you 4 healthcare stocks. I would just put a little bit in every one of them, or just put one in Cardinal Health. Now, on the crappy list, on the crappy side of the things, Align Technology, Dish, oh my, Dish, PayPal, Expedia, oh, Expedia. Let's take a look at Expedia. EXPD, right? Expedia. How do you spell Expedia? There it is, Expedia. Let's take a look at Expedia. Oh, it's already on the floor, huh? Yeah, more downside. More downside for NVIDIA. Maybe not right now. Maybe we'll have a little bounce because markets are a little overdone to the downside. But I think the route is going to take us further down. Also, I just want to remind you, any stock above $2, 38% above 50-day moving average, 35. Folks, we are in a bear market. And again, you got to keep the bond market, because if the bond's going to stay pressure, look, when we went up here, the bond market went up, yield was lowered, and stocks went higher. They got a little breathing room. But now we're coming back down, and I think we're going to erase most of this, and we're going to see the kind of pressure we haven't seen in a while. Now, before I let you go, with how news-driven and unpredictable markets have been lately, trading has been very challenging for most folks. It hasn't been a picnic for me either around WealthPress. That's why I love the quantum indicator. It helps me objectively decide where the market is likely headed using historic data. And I mean real data, not some what happened 3 days before, like 20 years of data, 10 years of data. Bull market, bear market, it doesn't matter to this tool. It signals long and short trades, which is critical these days. It allows me to quickly scan for stocks due for a pullback or a bounce. And tomorrow, Wednesday, at 1 p.m. Eastern Time, December 21st, I'll show you how it works, what it's signaling, and how you can add it to your trading toolbox. But you must click the link below, enter your email address to reserve your spot. It's happening tomorrow, 1 p.m. Eastern Time. Now, you trade swing trade, it works for swing trading. You do position trading, it works for position trading. Even if you do day trading on hourly charts, it works for hourly charts. It works for stocks, it works for other assets. It picked this bond short really, really well. And you guys need to get your hands, you got to get your paws on this thing. Follow the link below. Watch my trading session. I'm going to give all new examples of trades that happened the last couple of weeks, signals that happened the last 2 weeks. You guys are going to love it. It's happening at 1 p.m. Eastern Time. Tomorrow, Wednesday, at 1 o'clock Eastern Time. Do not miss it. Also, like my videos, subscribe to our WealthPress YouTube channel, and post comments. I'll respond to them. Yes, I will. And if all else fails, support at marketgeeks.com. Bye, guys. Have a great, great day.